Good morning, everybody. It is Tuesday, December 8th, 2020. This is the covered call. And I'm going to show you some screeners today over at Bar Chart. This is one of the services that I think if you are going to do covered calls and you're looking for options on options, if you're looking for different ideas, Bar Chart is probably the best thing I found for that. Now, if you have a list and you're going to stick to your list and you don't need screeners, then you're fine with just about anything that shows you relative strength index for daily and weekly charts. And you can get volatilities through your brokerage. But if you're looking for very good screeners, we already know that Stock Rover is one of the best super cheap ways to screen for stocks on fundamental basis with some limited technicals. Bar Chart is one of the cheapest ways to screen for technicals with a little bit of fundamentals. So whether you want to tilt towards fundamentals or tilt towards technicals, between Stock Rover and Bar Chart, you pretty much get everything. And you can even use Bar Chart for charting, a lot like TradingView, and not quite as comprehensive as TradingView, but pretty much, everything that you'd probably use unless you're really getting into swing trading. So I think between Stock Rover to find stock ideas and Bar Charts to find technical trading advice and ideas, those are two screeners. Now, you might not need a screener beyond the basics that you get at your brokerage and at Seeking Alpha and even Yahoo, because if you have a limited universe, you probably don't need those things at Stock Rover and Bar Chart. But if you wanted to be a lot more active and you needed more tools, these are both things that you could use. I use this and I pass on to you, readers of Fundamental Trends and Margin of Safety Investing, the ideas I find. So you may or may not need these, but I wanted you to be familiar with them. They both have free versions that you can, get limited use out of. So over here at Bar Chart, they have a lot of option screening tools. And so this tool, I just screened for relative strength index overbought, and I changed it to anything over 60 on the relative strength index. And it's kind of interesting to give you both the 20-day and the 100-day. And the 100-day, you can see that you have an awful lot of things starting to get overbought for a very long time. And what that means is that what I've showed you over on TradingView with the weekly overbought, these numbers are starting to tell you that the weeklies are getting overbought too. So they just do it as a 100-day, but they could have just as well put in weekly and it would have been similar information. So over here on the relative strength index, if we look from 60 and above, you just start to see a lot of stocks. And what I want to do is go down to the bottom, 929 stocks that they're tracking, basically the Russell 3000. So a third of all stocks are overbought or almost overbought. Now, if we only looked at the S&P 500, which I didn't set up, but I suppose we could, we'd have to add a market cap screener because they don't let you use S&P 500 if they're not paying for that copyright. Add a filter. Market cap, there we go. Haven't used this in a while, and now I forgot how to do it. Oh, there we go. So above $4 billion. All right, so we add the market cap, say above $4 billion. That's going to get all of your S&P 500 stocks and then some. Flip on the screen results, and you're seeing that almost every stock over $4 billion in market cap is either overbought or nearly overbought. So what does that tell you about the money flowing in through index funds and other sources? That there's a lot of liquidity out there. So again, I would warn you is that when this liquidity starts to dry up just a little bit, Mitch McConnell, Steve Mnuchin, you see what they're doing. We could get a bit of a liquidity shock, not really a crisis, because I think that they've sprayed the fire hose. It doesn't take a while for things to get dry. But a little less liquidity, and especially the appearance of less liquidity could really, bring this number down quickly. So covered calls are a pretty good strategy. So let's take a look at the covered call screener. Now I have this set up to cover the VSL and then some other VSL and then some other things. And you take a look and you start to see an awful lot of stocks that are getting what bar chart considers to be interesting options activity. 205 potential covered calls. So if you're using this, you'd want to whittle this down to really just the calls of the companies in your portfolio. So you can set up your own portfolio in here and then monitor that. Do the options view here. Get to see good things like implied volatility. Take a look at some of these. The implied volatilities are just huge. Palantir, which we talked about in stocks of the week briefly. Look how volatile that is. Pretty easy for this one to come down a lot quickly. So when you see these very high implied volatilities, you almost always want to either trim your position or write a covered call, because you're probably getting a pretty good premium on the covered call, but probably the stock is overbought. And we know that all of these are pretty much overbought. Over on the cash secured put side, we want to run a screen that shows us some ideas of something that we might want to get involved with. So take a look at Tesla. If you're just willing to throw in the towel and say, geez, I've got to get in on Tesla, look at this nice information here. You could sell a December put on Tesla, $580 strike price. That's $629 right now. So it'd take pretty decent correction for it to get put to you. Your break even is $559. So as long as the price of the stock doesn't go below $559, you're winning, right? Your potential return, 3.7%, because the premium is not super high. When you annualize that, right, if you did that every month, because it's about 1 month out, think about that, you're getting a heck of a return. So potentially, depends how things go. A lot of people trading this, high implied volatility. There's your delta there. Go right down the list of what you're seeing. So you have a lot of technology stocks in here. So here's one for Apple. If you decided that, hey, I would love to have a break even, in other words, cost basis on Apple of $107.20, I could sell the February put on Apple, looks like for $280, right? That's the bid they're showing you. And Apple would not get put to me unless it dropped down to 110, right around expiration time. If it does get put to me, my cost basis becomes 107.20. Even if it goes down to 100, your cost basis is still 107.20, and you're getting 2.6% to write this covered call cash secured put right now. So when you're looking to get into some of these stocks, I think that you should look at these cash secured puts and just take a conservative approach, especially if you're sitting on a mountain of cash and you're worried about the market getting away from you, which clearly it has with a lot of companies. So take a look at Alibaba. Alibaba is one that I think that you need to probably be getting involved with. So let's take a look at how many options they think are interesting with Alibaba. So a $240 strike price and a $230 strike price. What do we think about Alibaba? Well, the most important thing is that they're basically going to dominate the cloud over there in Southeast Asia, particularly in China. We know that it's fallen back a bit and it's approaching our buy zone. Optimal price, the first level of the optimal price range, about 225. So we go, okay, if I sell this $230 put and I get $495 for it, my break even or cost basis is 225, which is about where we were looking to get it at. Certainly we like to get it down here. So if you're jonesing to get your cash active, there's ways to do it that are safer than just buying the stock outright. Doesn't protect you against a correction below 225 really, but it puts some money in your pocket, 2.2% for a few months, and that's better than a money market account. So if you're looking to grind out high single digit returns by doing this 2 or 3 times a year, kind of cyclically, or 4 times or 5 times, even if you do shorter term options, then I think that, these are awfully good strategies for you. As far as ideas on what to do today, I will tell you that the stocks out there, there's so many of them that are close to overbought or overbought But all you really have to do is look into your portfolio and say, okay, what's overbought, especially on the weekly chart. What should I do about that? And we talked last week about when you should be buying and selling your stocks and when you should be selling options. If you're overbought on a weekly chart, you should probably be trimming your position and selling some covered calls. If you're oversold on a weekly chart or approaching it, you should be buying some stock and selling some cash secured puts. So it really entirely depends on where you are on weekly charts. The daily charts matter if you want to be more active and trade a lot. And then you're even going down to 4-hour and 1-hour charts and sometimes 15-minute charts. But we can see that Alibaba is near the bottom of where it usually gets to. Only got really overbought on the week, or oversold on the weekly one time recently, and two if you go all the way back to 2015. Otherwise, it's this middle area that you're dealing with. Now, this is pretty far off of a rally. Could it come down into in here? For sure. But should you be getting involved with it here? I think probably. I think the fact that Alibaba has been jitterbugging right in here for a little while is indicative of the strength in the stock in general. And people know that while it can go down into the 220s, there's a pretty good floor under it down here. So it just depends on how much risk you're willing to take. Now, I've taken a starter position in Alibaba, 1%, but I'm not going to add any unless it gets down into here. And that cash secured put at 230, it's not quite enough premium for me. So I would wait until Alibaba gets in here before I sold the cash secured put. So I always look at these charts first, especially the weekly. You can look at the daily as well, but I don't know that it helps you as much. I mean, if you're trading very short time frames, right, you plan to be out in between a week and a month, the daily chart is what you're going to probably use along with 4-hour charts, 1-hour charts, and again, sometimes some shorter term charts. But if you want something that you can hold with the idea that you're looking for the next big rally up, these weekly charts are the way to go. It's pretty clear this is where the huge support is. So while I took a starter position here, just because it came off the top, I think my cost basis is 255, bought it right in here. I wouldn't add more until it was approaching the 220s. You know, maybe right about here, I'd start thinking, you know, that orange line, I'm pretty comfortable buying right around here. So that's how you should set up your cash secured put. Now, if you don't own any Alibaba, maybe you do sell that cash secured put, and I'd probably even sell the shorter term 240, right? Why? Because it's more likely that this gets put to you and you want to own some of this long term. So if you don't own any Alibaba, maybe sell the January 240, get your $3 plus some premium. You know, it's not a ton of money for you. It's only 1.3%, but it's over 2 months, you know, a little bit less than 2 months. Actually, quite a bit less. Only about 5 weeks now, 6 weeks, 5 or 6 weeks. Can't get that in a money market on a whole year. You can get it here for 6 weeks. Worst case scenario, so you end up with a stock that you want at a cost basis that's in our buy zone. With the covered calls, you know, I mean, this is such a cluttered list right now. I should just clean it up to plug and play, and I haven't done that yet. You know, you take a look based on your potential return, and those ones with the super high potential return, those are super volatile stocks, usually smaller cap. Now we flip it to more reasonable returns, and you see names that you recognize. So Apple, you could sell some covered calls. The thing with Apple is it's one of the very few handful of forever stocks. And it's not terribly cheap. So you may not have the ability to write covered calls on Apple or Amazon or some of these stocks that are in the hundreds, right? Because now you're talking about pretty big blocks. If you're a retiree, though, with $1 million portfolio, you might have what, 3, 4, 500, 600 shares of Apple. In which case, you know, go ahead and maybe write some covered calls from time to time. The implied volatility is not huge, but it's still decent. So you go across these and you say, okay, well, I own this and I own that, and I can see on Apple's chart on the weekly, it's approaching overbought. So it's approaching this high again. Do you think it breaks out, or do you think it hits this 168 line, 618 line, and comes back? Or does it get back to this one line which got rejected last time? So you're in this area here with Apple where it's meeting some resistance. And I do think that Apple under 100 is probably a pretty strong buy. So you could almost sell a covered call, maybe $130 strike price, but you could also probably sell a cash secured put at $100. And think about this. Let's suppose the stock falls to 100 and it gets put to you. What does that mean? Not only did you collect the cash secured put premium, but that covered call premium, right? That covered call is going to expire. So you collected all that too. So really your added shares, your break even or cost basis on the new shares is 100 minus the cash secured put premium minus the covered call premium. So if you have a small Apple position that you're trying to build, that's something that you can do there. So all these strategies have to do with what you're trying to do with your portfolio. Are you trying to grow a position? Are you trying to trim a position? Where is the stock on the weekly chart? Is it overbought or approaching overbought? Is it oversold or approaching oversold? Is it kind of right in the middle? Is the volatility high enough where you can collect two premiums at once because the trading range is narrow enough? Like with Apple, goes down 25 bucks, you probably want to buy it. Goes up 15 bucks, you probably want to sell it. I mean, this is a rare spot, and you have to recognize what these look like sometime, where, yeah, I probably wouldn't mind selling a covered call up in here somewhere, and I'd love to get Apple at around 100. So you might be able to sell two options. I mean, it's rare that you can sell both sides, but every now and then you can, and it's a pretty good strategy. So if I were trying to build an Apple position, I could do that, right? If I had 100, but I wanted 200, right? Sell this covered call, sell this cash secured put. The odds are stock stays in this range and they just both expire and you collected extra premium. Somebody asked what moneyness is. That's just whether it's in or out of the money. So you see strike price is 112, but the current price of Apple is 123. It's 8.7% out of the money, right? It's just the percentage difference between price and strike price. Now, if you didn't know that, I would suggest that you have a little bit more to study before you really put your money at risk. You know, people have been confusing the cash secured put and covered call lingo and calling them cash covered puts and just saying it wrong. I'll tell you, if the language is hard to keep track of, that means that you're probably a step away or two steps away from really wanting to use these securities. They're great tools. It's like going from a screwdriver to a power screwdriver with a really big bit kit. But then you realize, well, I pretty much use the same 4 bits over and over and over again. So the options education over here at Bar Chart is very good. If you go to my YouTube page, which I've given a bit of a facelift, and you go over to the watch list that I have, go to technical trading videos. There's a lot of things in here. And what I'll do today is I will probably add some option videos. I have like 6 of them on my other screen right now for you to watch. There's a zillion of them out there. If you just go recall option strategy, you'll get a whole bunch, right? I could redo all of these, put my pretty face up there and do my own charts. But the reality is that there's just so much content out there that if you watch 4 or 5 of these, you probably get it. And each one's going to be a little different. So this guy's older. I would probably look at his. You know, all these kids telling you how to do things. Honestly, you know, I get scared when I see some guy who's 20-something or 30-something telling me how to do this, because then they're just a blogger. I'd rather listen to the retired guy who's probably doing this on his own portfolio. SMB Capital, I'm not really sure what that is. And they're not even trying to sell you anything. Oh, they are. They're trying to sell you a class. Don't buy the classes. Trust me. This is all free stuff. I'll put inside of Margin of Safety another option trading article with links and videos. You know, so instead of just being don't you dare trade options, so you read this, In fact, I'll probably even just update this with the links, and then I'll do getting started. But the covered calls, I tell you what, with as overvalued as the stock market is right now, you ought to be looking at every stock in your portfolio and pulling up this chart. Pull up your weekly chart, and then just go to RSI. And if RSI is up here, you need to be thinking on a weekly chart. Daily chart, not so important, right, if you're a long-term holder. But look, the monthly chart is overbought. When the longer-term time frames are overbought, that's really dangerous. So let's take a look. The 1 month is overbought. It happened August of 2018. So what happened in August of 2018? Remember, this is Apple. So it plateaued, and then it dropped 30%, right? So these longer term charts are important for you. Take a look at March or January of 2020, stock peaked, and take a look. There's your RSI. It was also January 2020. It also peaked. So Apple is probably ripe for a correction. How big? Who knows? Between 10 and 30% is pretty standard for them. But every now and then they get a 50%er, and that usually coincides with something bad going on. There's a lot of liquidity out there. I think it gets burned off gradually rather than falling off a cliff. That's why I'm a little concerned that we have a bear market coming, but I don't think it would last very long. A couple of months, longest case a year. I just don't see these 2, 3, 4, 5-year apocalyptic scenarios anymore, just because you now have a president of the United States who is going to undo all the executive orders from the last president of the United States, and that's going to be pretty stimulative. And unless he wins the Senate in Georgia, taxes won't go up, and that's pretty stimulative. Now, it means that there's a bigger problem brewing down the road with budgets and wealth inequality and all those other things. But sometimes we have to realize that these bubbles get blown up pretty far. So a small pullback in the stock market, right, your 10 to 20% variety, 20% is small, by the way, 10 to 20% variety probably is a buying opportunity given the liquidity out there, and the Democrats will do everything they can to stimulate. And the Republicans won't really allow them to raise taxes. So you could see a small pullback here and then to the moon through the next elections. And then, you know, that second half of the decade scenario that I've been worried about could play out. So in the shorter term, your month to month, your quarter to quarter trading, just mind these charts. And TradingView is so easy to use. I mean, you put in your 20 stocks here, you just glance at them every week. You know, I don't even know that you need to really hardly ever look at the daily chart. You just look at your weekly chart and your monthly chart, and you're going to have pretty good information. So on the monthly, Apple is overbought again. Probably means trim or sell a covered call. All right, are there any particular stocks you want to look at today? Okay, so step one, somebody asked about JD.com. Step one, start with your weekly chart. I generally look at the 5-year first so that I can get an idea what's been going on here. So just by looking at this, what do you immediately think? Well, this could be overbought, right? So what you see is it got overbought, and this is the area you should have been selling covered calls, and now it started coming down. I think now the question becomes is, how afraid are you? See this giant candle here on a weekly chart? It was a big up week. How afraid are, you know, and I don't know much about this company. I know what they are. How afraid are you that it comes all the way back down here to, you know, 65-ish? And that's where you have some support. The big support's under 50 though. So depending on what your position is here, I'd probably be trimming or at least selling the covered calls. And that's all you need to know. I mean, you've already determined that you should be doing something defensive here just by looking at this chart. Look how overbought the monthly is. Somebody asked about Invesco, and I can already tell you, you shouldn't be selling any covered calls on Invesco. Wow, that really has rallied a lot. It really took off. See, we were talking about buying it all in here. So who's sitting on a 60, 70, 80% gain right here? Somebody's got to be. Unfortunately, I bought it up around 14 because I thought this was going to hold. And it didn't. Bought at 760. Wow. Depending on how big that position is for you, I would probably trim a little. Remember we talked about last week, Maybe trim a sixth of the position, a quarter of the position, a third of the position, somewhere down there, between a sixth and a third of the position, go on and sell, and then sell some covered calls. I don't even know that there's a way to sell a cash secured put on this just yet. This looks like it'll be the new support, right? It's a whole month that it jitterbugged in here. So I guess, and then you see the support right there. So if you wanted to own Invesco, but you didn't want to buy here, which I apparently identified as a resistance area. If you own it, I think, like I said, trim it and sell some covered calls. But I do think Invesco's got pretty big upside, right? So don't completely bail on the position, because if it gets through here, it's got a ways to go, right? It can get into the 30s if it gets through this area now. So once it gets through about 21, 22, it could rally another $10. So I'd probably, like I said, trim a little here just to get your cost basis close to nothing. Then let it ride and see what happens. There's not a lot of risk with the company fundamentally. That's something that I talk about over and over and over again. So it's important to know the story of the company, right? But from a risk management standpoint, yeah. Then as far as if you want to get into this, see how it could fall down to this area here? You could sell like $15 cash secured puts. Oh, I always love these headlines. A dangerous move baby boomers are making. It really is amazing how easy it is to use Yahoo. So an $18 covered call, you get over $1 on. That's pretty good. Then a $15 cash secured put, not really getting much on. Yeah, I don't think there's a good way to sell a cash secured put on Invesco. Maybe a 16. Not much volume. Sometimes there's just not an option for options. All right, let's see here. Somebody says Maxion. So again, first thing you do is look at your chart. I don't know that this helps you all that much. It's right? The company just went public. So this is really a case of what do you know about the company? And if you don't know much about the company, after this rally, I would just sell it. It is a panel maker. And I'll tell you, the more and more I get involved with maybe starting more businesses, the more I realize that it's all about finding a way to have inputs that are cheap, that you can add value to. And like the guy who put in my new storm door yesterday, talking about buying a 3D printer because he had things that he wanted to do with motorcycle parts. He says, look, once I buy this 3D printer, the materials are pretty cheap. And I can do it and other people can't. So he can add, not actual motorcycle parts, but accessories. So to me, solar panels are becoming more and more commoditized. And if government is going to support the solar industry, it's going to be at the consumer level and at the research and development level. Why the research and development level? Because they want these panels to be as cheap as possible. So you would think that the margins will never expand dramatically on solar panels. It may even continue to contract. So just knowing that information and seeing this rally into the teeth of, actually into the horns of a raging bull market, I would probably look to just sell this. Could you sell covered calls? I guess you could. I would probably sell a $25 covered call for January, and I'd take all this off the table. If you get called away at a net price of 25, plus 390, 28.90, which is above today's price, but it lowers your cost basis, or it takes 390 out if it goes below 25. So now you're into it right in here again, right? You're taking out all that money. This is where it might get support, so it might stop falling. Yeah, that's what I would do. But I might sell it outright. It's not going to be on my plug and play list, put it that way. Commoditized product. It's not like they're pulling it out of the ground and there's a shortage of it. And we can produce as many of these panels as we want. Somebody says a cash secured put on LUMN. No, you should not do that. You should just buy the stock. I want to go back to 2018, which is what I've been doing on most of these charts now. Yeah. Why would you sell a cash secured put down here? Just buy the stock. It pays a 10% dividend. When the option that you're selling, especially with cash secured puts, if you want to sell a cash secured put, you usually are doing it on growth stock, actually, not on a dividend stock. The dividend stock, just buy the stock when it's cheap, collect the dividend, then when it rallies, sell a covered call. With a growth stock, if LUMN Technologies didn't have a dividend, I could see selling a cash secured put down here. But you're at a pretty big support zone. We've talked about LUMN. Yesterday it was in the stocks of the week, and that article will be up today. I'm recommending just buy it. Now, if you insisted, what I would do is I would buy a starter position, and then you could sell a cash secured put on your second entry. So if you bought today at 10, and you wanted to sell a cash secured put, so you had the 9, you get 18 cents. Whoop-de-doo. Just buy the stock. I don't think there's a good cash secured put strategy. The premiums are low because people know that there's not a lot of downside. AMD, have you looked at the chart? Okay. What's your first? I could just look at this and tell you should be trimming. It's coming off of the overbought on the weekly. Monthly is overbought still. So yeah, almost everything in the stock market you should be trimming. There's so few things out there that are genuinely undervalued. Riot Blockchain. Yeah, that's what we looked at. What's going on here? Such a weird chart. All right, so we want to go back to 2018 because that's when New World started apparently on a weekly chart. Yeah, that was the major hype, right? Then a crash. I don't know much about the company, so I can't tell you from a story standpoint, but I can show you that. Monthly is not quite there yet, but it's close. I think this one's a real good one for covered calls, actually. If you think that this is one of those stocks that can grow tenfold, right? That's the thing you have to ask yourself. Is this a potential 10-bagger from here? And this is just a start of a breakout. I don't know. I don't know the answer to that. So you have to ask yourself that. Now, if you think it might be, maybe trim, because I'm presuming your cost basis is down in here somewhere. Trim a little, right? A couple covered calls, but keep a solid third to half of the position intact so that if this is really potential breakout someday, all you're doing is, you're trimming back a little bit. And then if you do get a correction, then take the money that you just received, put it back into the stock. So that ebb and flow partial trading, that's scaling in and scaling out, that gives you a lot of flexibility. So if you sold a third of your position and wrote cover calls on a third of your position, the stock jitterbugs and came down a little bit, call doesn't get called away, still have 2/3 of your position, and you sold a third of your position, and if you wanted, you can reinvest that money into the same number of shares or even more shares because you have the cash at a lower price. I don't know how likely it is that this stock comes all the way back down here to 5-ish, 5 or 6-ish. I don't know. I just don't know the story on this one. I wish I did. So you have to make that qualitative analysis. SunPower we'll finish with again. SunPower puts. So I do know the story on SunPower. I do still think it has a shot to go to 100 or higher because they are an asset-light business now. So on the weekly, it's just coming off of overbought. So, this is probably you should be selling covered calls, right? Oh, just coming off of overbought. So we talked about this one a while back. So, back in here, we were saying trim or write some covered calls. I don't know that, right, this area here might be the place to start getting more of the stock if we don't have it. But I think probably down in here. I've been doing this long enough to know when the market's getting dangerous, when the narratives are just getting silly. I was watching the Goldman Sachs guy today on Bloomberg or CNBC. I think I went to CNBC because they usually have some good interviews, although I can't stand listening to the talking heads. But the interviews are generally decent. And one of the Goldman Sachs analysts, they trot out a different Goldman Sachs person every week, right? So this guy was basically saying there's $1 trillion more in money market accounts today than there was a year ago. And that's kind of true. He doesn't break it down to where the money came from and whose it is. And that's really important. So I've talked to you about the money markets because people bring it up and just say, hey, $1 trillion more. Well, not that easy. Hundreds of billions of that will never, ever, ever see the stock market. And to the Goldman Sachs guy credit, he said the same thing. He said, about half that money could find its way into the stock market. Well, it's that one word in there about what I just said. Which word is it? Which word did I just say that's really important? About. That's right, Vince. Vince is a sharp guy. About half of that money could find its way into the stock market. Okay, so let's say about half of that money could find its way into the stock market. I think that's high, probably by double, but let's say it's $500 billion find its way into the stock market. We know that there's leverage on leverage in the market right now, and we know that the pension funds are net sellers forever because there's only old people in pensions now, or older people in pensions. Younger people aren't in the pensions. So there's not new money going in. So the pensions are in net withdrawal. The boomers are in net withdrawal. If there's really a $500 billion investable out there in money markets, where do you think it's going to go? What have I been talking about for months and months that you should be looking at buying in the next year or so? Real estate. A lot of that money is going to go into real estate. And a lot of that money is vulture money. A lot of that money is going to go overseas in the foreign investments because we all know that the emerging markets is where it's at. That's why we have the emerging markets internet and e-commerce fund. So Ashley, let's finish on that. I want you to find a way to own this for the long term. There's a pretty good floor in here in the low 50s. So here's an ETF to sell cash secured puts on probably soon. And I talked about it a couple of weeks ago when it was lower. Oh, that's right. They didn't have any freaking option volume. So I just talked about buying it. I would set limit orders to buy this at 52. That's what I've done. I have limit orders to buy this at 52. You could do 51. If suddenly the dollar gets stronger, like significantly stronger, then cancel your order because a super strong dollar would drive this all the way back down to here, 40-ish. I think 52-ish is where you want to add to this. I've already got a small position. I've showed you what this owns. There's no option market, so unfortunately, options don't work. Now, we could all start putting in cash secured put orders at 54, and maybe we can create a market here. If you can get $1.40 on a $54 put, I think you should sell it. In fact, I'm going to look at that today. If they'll fill my order at $1.40, heck, I probably can go down to $1.25. I think I'd probably do that. So not a lot of activity. I think that would be a good one there. Because this owns Alibaba and JD and Mercado Libre, and you can just go right down in Jumeirah, which is in Africa. Go right down the list. This is going to be the big winner in emerging markets. It's not going to be commodities, except in a couple countries, in which case you ought to just buy that commodity or a miner. These are going to be the guys that make money because they're skipping a stage. They're not going to build malls just to have the internet close their malls, right? They're going to skip a whole stage in development, just like they're not going to put in a bunch of copper wire for telephones. They're going to go straight, right, to cell phones, which is what's been going on for 10 years. Their e-commerce is going to explode. And it's already happening in Asia, and it's actually already starting to happen in Africa. A lot of these companies ran up recently, right, since March. So this area down in here, pretty strong support. I think it would take another really horrible thing to drive it back down here for sure. You'd have to have a depression. And even here, I think that was just the start of a breakout that if you get rid of, imagine that this doesn't exist. Imagine that this just went like that, right? Imagine that this area isn't in here from COVID. It just went like this. Where would we be looking to get it back? Right here would probably be a good spot. You see, this is where the jitterbug happened. And we'd have to have a continuation of the recession, push it back down into here, I think. So we'll see. I mean, maybe Mitch McConnell will throw the whole world into a recession and we won't come out of this with the vaccines, but I don't know. I think at some point, people put the screws to him because it's close enough in the Senate, even if the Democrats don't take Georgia. And frankly, if we screw things up here, the rest of the world's going to leave us behind. The emerging markets are emerging finally after I've been listening to this argument for 30 years. It's finally happening. It's not just China anymore. Now it's going to be everybody else. Indonesia, Malaysia, the Middle East, Africa, the rest of Eastern Europe that didn't already rally. Yeah, right. Mark Mobius, 1990. And that's who I was listening to. And he's right but he was way early. Who does that sound like? All right. Have a great day. I'll get these videos up shortly. I've got like 4 articles to catch up on.